first stock tonight. Clothing retailer Foschini reported that headline earnings per share rose by 26% to 341.9 cents in the 6 months to the end of September, and that's compared with 272.3 cents a year earlier, as wage increases and decade-low interest rates helped lift consumer spending in Africa's top economy. Foschini, which competes with Mr. Price and Truworths, said sales increased 18.5% to 9.9 billion rand. Gentlemen, welcome to the program. Great to have you on. Tshepo, let's start off with you. Foschini, it's a stock that everyone says is always very expensive, but for good reason, because it's always posting double-digit growth. I know you probably think Foschini is expensive, don't you? But great results.
Great results. Spectacular results, especially considering what they keep touching on, the high base from the World Cup last year, to produce results like this across all their divisions. Actually, double-digit growth across most of their divisions is a superb set of numbers.
Gerbrand, were you impressed with the numbers that came through today? And of course, they've embarked on many strategies since the crisis, and that has actually worked and put them in good stead.
Yeah, certainly. I think it's much better than what was expected, and also better than what was guided about 2 or 3 weeks back as well from the group. So 26% rise, brilliantly. But if you look at Foschini, it's probably been lagging the rest of the retail industry. So it didn't have very great numbers over the last 3 or 4 years. I think their growth for 2011 was dismal against its peers, and that's why it's probably got a lower rating than the others. But going forward with these kinds of results, they probably can do some catch up against some of their peers, although we think that retailers in a whole in South Africa are looking very toppish on earnings and on prices at the moment.
So, and when you say toppish, so in other words, you're expecting more downside down the line, that these numbers are not sustainable?
Well, certainly from an investment point of view, there's no margin of safety investing in most of these retailers locally at the moment. I mean, look at, you can take Shoprite even on the food side, you can take Truworths or Mr. Price, or Foschini on the clothing and some other apparel sides as well. So it's seriously looking very toppish. We know there's an Africa theme going on. We know there's people looking at some of our retailers to invest more in Africa, etc. But from an investment point of view, there's just not enough margin of safety on what you're paying for these companies at the moment. Remember, normalized earnings do happen from time to time. They had everything in their favor over the past time. They had a strong currency over the last 2 or 3 years. They had lower input costs. They had, like you said earlier as well, wage growth in South Africa, subsidies from the state coming through as well, probably better than what we expected. So a lot of positive things coming out. And I don't know what else more positive can come out for the retailer. So it's very difficult at this stage to do new investments into some of these.
Well, another positive thing that could come out, we've got an MPC rate decision next week. We've just had the ECB cutting by 25 basis points. We possibly have a default coming through from Europe, but let's not get into that drama. But we could actually see another interest rate cut in the country. Would that then boost something like Foschini?
Look, you could. I think. Sure. I don't know if
because the credit earnings mix basically is around 68% credit, and then you've got around 32% cash. So it's still a massive cash credit portion coming through.
No, for sure. So what it will do is it will boost, I guess, general demand for credit. But to be fair, given the interest rates that some of these credit retailers are charging, I don't know if a 50 basis points cut in an interest rate is going to spark added activity specifically in that sector. I think they're probably charging interest rates in the 20s right now. So yeah, I don't know if the MPC meeting will be a significant catalyst for this particular counter.
And also 2 new brands that came through for Foschini. We had the likes of Charles & Keith. It's basically a men's footwear and accessory store. And then also we had Fabiani coming through as well. So they're expanding, and this is in the luxury space, which is quite interesting that they're targeting this.
Yeah, certainly. They're targeting middle class and high income class as well. So very interesting from their side. They got an Africa growth story as well that they mentioned today, 58 stores that they want to open in some of the African countries where they already operate, and they want to add to that Nigeria and I think Mozambique as well. So don't take me wrong on my negativity about the share price. It's a great company. It's been doing very well over the last 18 months. These numbers were surprising on the upside. But just out of the general consensus about retailers at the moment, look, if you need to buy a retailer, this is probably it in that space. You're getting it at a 15 PE while you're looking at Woolies at a 19 PE and Mr. Price I think at a 17 or 18 PE. So certainly it's looking the cheapest of their more expensive shares on the JSE, but it's still probably not where you want.
And it's got quite a nice dividend yield as well, sitting at around 3.9%.
Certainly, and they increased that by 38%, so that comes down to about 3.94%, which is very lucrative for people wanting to hold stocks who increase dividends over time.
Are you expecting more good news for the South African consumer down the line and for retailers? Because for some time now, the retail sector, retail companies have actually been pricing in the good news.
Yeah.
So they're forward-looking. This is what we expect from share prices, right?
Look, to be fair, I think the good news has filtered through. I don't think you can say that these retailers have been struggling, barring a Pick and Pay as an example. But I think across the board, if you look at the Woolworths numbers, you look at the Shoprite numbers, you look at these particular set of numbers, it is filtering through in terms of earnings for these counters. So is there more good news to come out? That's
and these numbers possibly
will
be hard to beat going forward because then it's going to be off a high base.
It is. I think their acquisitions could potentially help. They're diversifying across the different LSMs, I think. So for sure, I think that places them in terms of strategy at a good footprint.
And Gerbrand mentioned a very interesting point with regards to the Africa strategy, because they've got 70 stores outside of South Africa, 56 in Namibia, that's the biggest chunk, 6 in Botswana, 4 in Zambia, and we've got 4 in Swaziland, and then they plan to open 4 new stores in Lesotho, Mozambique and Nigeria.
See, the issue I'd have in terms of this African expansion is it's one thing to understand retail in the South African context and to understand credit in the South African context. I think the key question will be around credit in the African context. So I think that introduces a risk factor. Whether they're able to do it or not will likely.
Do they operate the RCS brand in the rest of Africa? Surely they would.
No, I would think they would. I mean, if the sales comprise about 70% credit, then they should probably look at something similar or just import that.
This probably won't mean much to you, but Zara is going to be opening up as well next week. I spoke to the CEO a little earlier today and I asked him about the impact of Zara, and he said it remains to be seen, but he did mention the credit effect and said that if Zara obviously brings in the credit element for consumers and they open up nationwide, then that would be of concern.
No, it would. I don't know if I can add any more to that. So I'll sit on the fence on that particular.
For you, Gerbrand, Zara, is that, increase in competition, can Foschini be shaken in the whole retail industry, in fact?
Yeah, look, I think over the last year or two, people were actually living nicely off failures of Edgar's and Edcon Group over the last 2 years. So that probably bolstered them as well. But good competition will always probably look down to margins. But all of these retailers are at record margins at the moment, which does scare me a bit.
Okay, so hot or not? Should I even ask you? Not hot.
No,
too hot.
No, not hot. I think if you need to buy a retailer, you probably want to look at Foschini.
Okay.
But retail in whole is too expensive for us at the moment.
It's too expensive, Gerbrand. I'm assuming it's too expensive for you.
It's very expensive. I think within the retailers, the furniture retailers are the ones actually providing some sort of upside. So Lewis is one that is actually not looking expensive. But yeah, if you're looking at a through the cycle P of above 20, very rich for us. So yeah, not hot at all.
Okay, let's delve into the next stock. Old Mutual said third quarter revenue rose 8%, helped by growth in Africa, Asia and Latin America. Life assurance sales grew to £358 million from £331 million a year earlier. Funds under management declined 5% to £116.1 billion. Old Mutual, a market cap of 80 billion rand, a P of 9 and a dividend yield of 3.6%. And Tshepo, for you, the third quarter update also coming through from Nedbank in yesterday's session, and it seems a developed world is what's dragging Old Mutual down, emerging markets looking strong.
I think that generally follows the theme of economic growth as well. Globally, you're looking at emerging markets of growth coming out of those particular areas, and developed markets struggling. I think if you look at, in particular, that US asset management business, that struggled quite a bit. I guess the pleasing part about those particular outflows, even though most outflows can't be pleasing, is that it's in the cash, specifically cash investments, and the margin on those is actually fairly low. I think they talk to 5 basis points on that. So overall, I think from our side, pretty decent set of numbers. We like the growth emanating out of emerging markets in particular. Concerns around that US asset management business.
US, do you think was a mistake from the beginning? Because they were burnt there?
Yeah, certainly. Look, the group's going through restructuring at the moment. We know the life business they've sold already. There's a few risks in there inherent still, but that looks a bit less this time around. But yeah, I think I'm exactly on the same as our colleague to my right. They're doing well in all the other areas. If you look at their growth in life sales, I think that grew by about 8%. Emerging market, there was some growth there of about 30% on some of it. But certainly it's a difficult competitive environment in the US, and I think we saw that with some of our other local companies as well. Trying to do some business in the US is not the easiest place. UK probably the same, and Europe the same as well. It's very difficult and very competitive out there.
With regards to Nedbank, we know that they have said in the past that they're committed to selling their majority stake in Nedbank. Nedbank turned around quite nicely, in fact. Yesterday we saw some interesting numbers that came through. The credit loss ratio is also coming down slightly, still not below that key 1% level. What is your sense of what kind of value can be unlocked of that? I mean, do you think it's going to be the best for shareholders?
Look, I think there's quite a bit of value. We're actually fairly bullish in terms of Nedbank as an investment case as well. So I think there's quite a bit of value to be unlocked from that. It is pleasing that the one business that they're actually looking to offload is doing fairly well themselves.
So would it be wise then?
Look, I think from a group perspective, I agree with the principle of looking to focus on your core business. So I think it potentially, if they can get the right price for the asset, it is the right strategy for Old Mutual as a group, I think.
Offloading Nedbank is wise?
Yeah, look, I think it's a bit difficult to say, but I know some of the performance remuneration, etc., was linked to some balance sheet cleanup, etc., and I hope that was not part of the strategy by selling Nedbank those days. But certainly, Nedbank is delivering nice earnings. As you said, the impairment charges have dropped from 1.2 something to 1.1, 17 or 20% on earnings growth. We're looking to at the banks locally at the moment. So certainly one of the sectors that we like as well. So from a strategy point of view, if I were a holder of one of these companies, I wouldn't want to sell them at the moment. Okay,
so you'd keep to your investments on Old Mutual and Nedbank. I mean, if we see quite a nice significant turnaround in Nedbank, which of course is steadily occurring, then Old Mutual can ask for a far more hefty price. Isn't that the strategy, right?
It really boils down to the price that they sell their Nedbank asset at, I think, to say whether it's good for Old Mutual or not.
And of course, they're talking about smaller disposals as well by the end of 2012. What is your sense?
Again, I think the thesis is to clean up their exposures. I think at some stage they went on a strategy to conquer the whole world. We like management strategy to refocus on the core business, sell off non-core assets and use that to
Do you think they're alluding to developed market assets right now? Wouldn't it be wise to sell at the bottom of the cycle?
Look, you could argue that from an economic perspective, it probably isn't the right time to sell. But again, it goes to
unless you believe the world is really going to fall apart.
But again, there's an implicit opportunity cost to those assets. So if you can grow faster somewhere else, then so be it.
Life insurance business, I mean, the competition is heating up quite extensively here as well in South Africa.
Yeah, certainly. We know that there's a few more entrants in the local market over the last 12 months. It would be interesting to see what the numbers on the breakdowns look like. I mean, I haven't looked exactly to what South Africa, Europe, etc. is on the life insurance side. As a whole, they're looking good. Not a problem on that side. But certainly a lot of competition coming into the local market as well.
Fantastic. On that note, gentlemen, hot or not, Old Mutual at these levels?
I'm going to go for hot because the right way of doing these companies are embedded value, and I think they still trade at about a 25% discount at the moment.
There's two ways of looking at it: in better value and some of the parts, and on our very conservative some of the parts valuation, we think the stock is probably closer to being worth than 20 rand, if not more than that. So from our perspective, very hot.
Very hot.
Very
and
hot.
I know that you like Nedbank as well. Nedbank hot for you.
So hot on everything green.
We do like the banks at the moment as well.
Banks overall or Nedbank in particular?
Well, I think any of the four big banks at the moment are looking okay.